Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. And yes, she's back. Anna took a week off to spend time with her family at one of her luxury Airbnbs down in Florida, I believe. So, Anna, how you doing?
I'm doing amazing. Yes, I was at my place in Ocean City, Maryland. And next week we head to the lake and then we go to Florida and Texas and we enjoy lifestyle investing for sure.
Lifestyle investing. I love that, folks. Again, folks, Anna has an amazing playlist, hundreds of hours. Need to check it out. Want to hear about lifestyle investing? It's in there. Want to hear about the lake house, or it's all there. Check her out. But Anna, it is Wednesday, the 15th of June. It is what I call Fed Day. Yeah, it's going to be it's only like 4 hours away, 3 hours away. So what do you think is going to happen? What do you think they do? Where do we go from here? There's just so much going on. What's going on in your mind?
So I'm not a bettor, but I'll bet you $10,000 they raise rates today. Maybe I should do $1 million, but I don't want to
say 10 grand. Right, yeah, come on. Yeah, I think the chances they do zero are zero.
Right. That's a pretty good bet. So the question is it 50 basis points or do they go up 75 basis points? And, I think your guess is as good as mine. I think they need to go up 75 basis points. I think they do. And I think that they might. Powell was saying last time, basically promising only a 50 basis point hike. Inflation numbers came out much hotter than they expected. But the markets are also tanking. And so if they go out too fast, it could show fear from them, which could stoke some fear in the marketplace. If they come out too slow, it could show being a little too dovish and not doing enough and stoke more fear in the marketplace. So I think the bottom line is they know they have to kill jobs and push us closer to a recession in order to destroy inflation. And if they're honest with themselves, I think they have to come out with 0.75 point bump.
Yeah. So this is kind of where I've been for a while. They have to do 75, right? I even think Wall Street expects 75.
Yes.
I think it's 98.5% people now expect 75. So if the Fed doesn't give 75, I think the market tanks.
Yeah,
right?
It could.
Right. I think the market's like, okay, you're totally, we knew you weren't good at this, but now you're totally clueless. Right.
Yeah.
So I think
agree with you.
Yeah. So I think they have to do 75. I'm going to ask this. I think I know the answer, but you know who Sam Zell is?
Yes.
Yes. I figured. He actually came out this morning and repeated what I've been saying for the last 48 hours, that the Fed needs to do the unexpected. A week ago, the unexpected was 75. It's not anymore. So in my world, I want the Fed to do 100. I want the Fed to do Paul Volcker. I want the Fed to surprise. I want the Fed to stop communicating to Wall Street what is coming, because they should care about Main Street more than Wall Street. As long as they keep giving the market what they want, just little medicine at a time, this is going to go on for a while. And then lastly, this talk of a soft landing is a joke. It's a joke.
Yeah.
The only question is, how hard is this going to land?
Yeah.
What do you think of all that?
Yeah, Michael, it's a really good point. I mean, I think the Fed is really between a rock and a hard place, and they don't want to admit it, but they're basically saying when Powell came out and he was basically talking last rate increase that, the job market is too wide. There's too many jobs. Basically what he was saying is we're going to destroy the job market. We don't have a choice, right? They're not going to say it that hard. But inflation is so bad and so not transitory, right, that they have to come out strong. The problem with that is we have basically close to 2 decades of easy money, fiscal policy easy, and monetary policy easy. So combination of low rates, incentivizing massive amounts of corporate debt, real estate debt, household debt. Then we have stimulus from the government to pull us out of the pandemic, trillions of dollars in stimulus money. It's created a major inflation. The Fed has 2 real mandates: keep unemployment low and keep inflation about 2%. They can't usually get the balance right with a lot of easy money and easy debt, right? So they have this kind of shadow mandate. It's not explicit, but it's to keep credits and markets in balance. And so they don't want to see the credit market collapse. loans to investors collapse. They don't want to see the stock market collapse, but yet they have to cause some pain, AKA kill jobs, rise unemployment in order to get inflation down. I think the reason they've been slow, and I know I've mentioned this before, but for those of the listeners who haven't heard us talk about it, is we have so much debt, and so much of it, I think the vast majority of it is variable interest rate debt. So the Fed had to come out and say, okay, we're warning you, you better get your house in order. All this variable debt coming new, you better refinance it before we really hike rates. And so they've been slow because they know that there's so much debt. They can't pull a Paul Volcker with the level of debt we have in the system that's variable. And that's what's very different than the 1970s that I don't hear a lot of people talk about, is that during the 70s, Volcker was not dealing with mass amounts of debt and variable debt. Now we have so much debt in the federal government, in households, in businesses, in real estate, that's all variable. So if they pull a Volcker and go up high really fast before people have been warned to get your house in order, we're really doing this, I think they would have completely crashed the system, on the verge of depression. Forget recession, but I'm talking depression. And I think we still teeter on the fallout of all of this, leading us to much worse than recession and real economic pain that can last quite a long time. So I think they've warned us enough. And I think that they're going to get aggressive now and say, listen, we've warned you for essentially 10 months that we're going to raise rates. Now we have no choice. If you haven't reacted quickly enough,
it's on you.
On you, right? They're not going to pull a Fed put and bail people out this time. They can't.
No, that is very different, right? For 40 years, right? My 52-year spreadsheet clearly shows that 40 years interest rates essentially went one direction. We are going to have, in my opinion, somewhere between 2 and 4 years where rates go up. And that's going to be a problem in lots of places. We're already seeing it in Silicon Valley land, lots of private companies, crypto companies, all these folks having to lay off. Their burn rates are bad. We're having down rounds in tech companies. It's real pain. We're going to see real pain. We'll talk about it in episode 2 in the kind of multifamily new syndicator market. Rod Khleif was on yesterday, and it's like, wow, this is going to be bad. But yeah, I think that concept about how hard it landing and I don't really know where a recession and depression line is. This is going to be a bad recession. And I'm not even sure the game has started yet. Right. Yeah. People like to use the baseball analogy of 9 innings. We could still be warming up. Right. We may not even be in the first inning yet. Right. So we haven't even had the national anthem. And then you see mortgage rates, 30-year mortgage rates jump to 6.38, and the Fed is still at 0.75 as of yesterday. I mean, that's massive. The 2-year notes like 3.5 or something. I mean, gosh.
Right. And the scary thing is, Michael, when you look back at history, and I've looked at where the Fed rate was and where the inflation rate was back to, I think, 1940, something like that.
Wow.
Essentially, and a lot of economists that are kind of the doomsday or naysayers are saying, listen, the Fed has to get rates above inflation to kill it. Well, if inflation's at, published almost 9, probably worse, we're talking interest rates well above 9% to bring it down, right? So essentially, there's so many issues on the supply side that the Fed has no choice but to kill demand. And the only way they can kill demand in an otherwise fairly hot economy with a lot of free-flowing money is basically destroy the ability to borrow. And when they do that, companies quit borrowing, individuals quit borrowing, individuals quit buying, drives prices down, forces these, job freezes and layoffs. And we're just starting to see the beginning of all of that. Unless the supply side stuff fixes itself soon, that's the part that people are just relying too much on the rates. They're going to fix it, right? But the underlying problem is there's supply side issues, both the supply chain issues, the realignment of resources and trade globally to try to come back to some level of protectionary mechanism. Let's produce all of our own stuff at home. Those things could take years to play out. The other thing that really worries me and makes me think we're at the beginning, to your point, is that we have done so little investing in commodities over the last 40 years. Last 15 years, while GDP has gone up significantly, Commodity investing has only been 1% of US GDP. So we have a scarce resource problem, scarce oil, scarce gas. Those drive a huge portion of GDP. And so if the supply side stuff doesn't fix, and it doesn't, you don't just produce a lot more energy overnight, that could take years. And so you could have high inflation in energy and in food and in housing, whether that happens or not is our guess, but you can have high inflation there with deep recession elsewhere. And that means inflation could be elevated for a while. And I'm thinking we could be in 4 or 5 years of inflation, maybe a decade of much higher inflation than what we're used to.
No, for sure.
And that this is only the beginning.
Yeah.
I hate to think that that's going to play out. There's a lot of geopolitical issues that are going to impact that. But I think we're in for some longer term inflation. And it's why investing in hard assets like real estate is still the place that I want to be.
Yeah. And that just goes back to kind of where my head is at as well. Right. I think we're in for years of what economists call stagflation, right? High inflation, low growth. It's like, hello, we're kind of there. You don't need to look in the rearview mirror to realize we have high inflation and low growth.
Absolutely.
The second thing you brought up is it's frankly why I don't want variable rate debt. I think a lot of people are like, Michael, you don't get it. I'm going to get an arm. You and I both know the Fed's going to jack up rates and then next year they're going to lower. I'm like, you really want to make that bet? Really? Did you not see the 70s? Again, it could happen. My crystal ball is as broken as others, but I certainly don't have that level of confidence. You really think the Fed's going to take us, the Fed funds will take us to 4, 4.5, and then suddenly they're going to cut it to 3? You want to make that bet? There's a lot of people making that bet today, Anna.
And I think the reason is because people don't look back in the history as long as we do, right? There's a lot of people who've only been investing in anything for a few years. And so we do see a pattern that when we hit recession, the Fed cuts rates. When we hit recession, the Fed cuts rates. And it happens over and over again. But the problem is when rates have been so low for so long, increasing amounts of debt in the system to produce growth, which is essentially what they do when they cut rates. They promote you borrowing more money, stimulate production, get the economy booming again, right? Mm-hmm. So the problem is we've had so much debt in the system and we're still not booming. And for every new dollar of debt, the amount of GDP produced by that dollar goes down significantly. Yeah. So they've already seen that we can't just give more free money because as soon as we do that, inflation hasn't been killed yet. It's going to continue. So the Fed normally drops rates in a recession because usually the inflation is over. We haven't seen this level of inflation and debt since really the 1940s, way earlier than the 1970s when we had both debt and inflation. Took a long time to take care of. So I wish rates would come right back down. But until these supply chain issues fix themselves, the global energy production, global food crisis, 50% of the globe has not enough food production, right? Until the food and energy problem is taken care of on the supply side, inflation is going to continue. So the Fed cannot lower rates and give more free money. Then you come right back to us spending more money again and driving up prices. So they're really between a rock and a hard place. And I think they have to get aggressive. And they have to stick with it a while to make sure that they don't temporarily fix it and it comes back rearing its ugly head even worse.
Yeah, I agree with all of that. And to that last point, they actually did that in the 80s. Paul Volcker did his move, paused, and we had a double dip recession. And let me just tell you, the second dip, much worse than the first. So I agree with you. If you're going to kill it, kill it. And let's go. Anna, where can people find you? You put out amazing stuff.
Great. Thank you. You can find me here every weekend on my playlist. You can find me at Anna Kelly, REI Mom on social media. And my website is reimom.com.
Thank you very much.
Thank you.